What is a balance sheet? A balance sheet is one of the three main financial statements that companies publish, alongside the income statement and cash flow statement. In plain English, it's like a financial snapshot. It shows what a company owns, called assets, what it owes, called liabilities, and the value left over for its shareholders, called equity, all at a single point in time. It's called a balance sheet because the two sides must match. Assets equals liabilities plus equity. Why does it matter? The balance sheet is important because it gives you a clear picture of a company's financial health. It answers practical questions like, does the business have enough cash to cover its debts? How much is tied up in property, stock, or equipment? Is it funded mainly by borrowing money or by shareholder investment? For investors, this matters emotionally too. Looking at a balance sheet can provide reassurance that a company isn't drowning in debt or, alternatively, can highlight risks you might not see from the profit figures alone. And it's not just investors who care. Banks use balance sheets to decide if they should lend more money, suppliers check them to see if the company is reliable, and employees might look for signs of stability in their workplace. Here's a simple example. Imagine a small bakery. Assets. It owns £50,000 worth of ovens, £10,000 worth of ingredients, and has £5,000 in cash. Total assets equals £65,000. Liabilities. It owes £20,000 on a bank loan. Equity, the owner's share, is what's left over. £65,000 minus £20,000 equals £45,000. On the balance sheet, the equation still works. Assets, which is £65,000, liabilities, which is £20,000, plus equity, which is £45,000. You can think of your own life in the same way. Your personal balance sheet might include what you own, car, savings account, laptop, minus what you owe, credit card debt, student loan, mortgage. The leftover is your personal equity. What else should you know? A few key points make balance sheets more useful. It's a snapshot, not a movie. It shows the company's position on one specific date, for example the 31st of December, but doesn't tell you how things have changed over time. Types of assets and liabilities. Current means within 12 months, like cash, stock, or bills to be paid soon. Non-current is longer term, like property, machinery, or long-term loans. This split helps you see how quickly things could be turned into cash. Not all assets are equal. Cash is very different from machinery. Some assets are liquid, easy to spend, while others are harder to convert quickly. Debt can be good or bad. A company with lots of borrowing might look risky, but if that debt is being used to grow the business, it could be a smart move. Comparisons matter. A balance sheet is most useful when compared with previous years or with other companies in the same industry. Ratios reveal insights. Investors use balance sheets to calculate things like liquidity, can the company pay its short-term bills? And leverage, is it funding itself more with debt or equity? Equity isn't the same as market value. The equity figure on the balance sheet shows accounting value, not necessarily what the company would sell for in the stock market. Market value depends on the share price, which can be very different. Limitations. It doesn't show future commitments, like contracts signed but not yet paid, and it records things at historical cost, which might not match today's market value. To sum it all up, a balance sheet is a company's financial snapshot, what it owns, what it owes, and what's left for shareholders. It's useful for spotting strengths and weaknesses, and investors use it to check liquidity and debt levels. But remember, it's only one piece of the puzzle. To truly understand a company's health, combine it with the income statement and cash flow statement. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.